Hello again. This is Daniel Feynman, and welcome to Finance for the Non-Financial Business Executive. Module 7, Financial Analysis is so critical to success, or From Ratios to the Z-Score. Now, we always start financial analysis with ratios. Why? Because they're so easy to calculate. But in reality, there's 5 different categories: liquidity, utilization, leverage, profitability, and market ratios. Now, liquidity ratio attempts to measure our liquidity. It ties into our working capital conversation. Utilization is our turnover. It's how we're using our particular assets. Leverage, which ties into our conversation in the previous module on what our leverage actually is. Well, should we change it? How do people look at it, both from the debt side and the equity side? Our profitability ratios not only measure what our profitability is, but in proportion to what? And compared to what benchmark? The first 4 categories are very objective. They're calculated based on our historical numbers and our performance. But the market ratios, these are subject to change by the minute because they're related to the market conditions, particularly if we're talking about a public company versus an in-house company. So once we've calculated these various ratios, then we can calculate both our operating cycle and our cash cycle. In other words, how long is our cash actually tied up in our operating world? Well, this spreadsheet allows you to look at what your operating and cash cycles have been in the past, what they are today, and by changing the elements that are within your control, what you'd like them to be in the future, and what activities you have to take. Then we have a very interesting challenge of looking at, which most of us do on a regular basis, when do we make the product or service versus buying it? In-house versus outsource. Formula for part of it, decision on intangibles for the other part. And we'll wrap this module up with the second Excel model in this particular element, looking at the Z-score, that well-tested model that predicts with very high accuracy, both for clients and for customers, the probability of default in the next 18 to 24 months. There's not just one, though. There are 3 different models, depending on the industry. So, until next time, this is Daniel Feynman having fun with finance.